Hello, George. The Global Value team has had an excellent year, posting close to 30% returns in its major products. My question for you is, with that kind of market appreciation behind us, why do you remain optimistic about your holdings going into 2026?
Well, we're optimistic for several reasons. First, we're diversified across geographies. After years of strong US dollar and US equity market performance, global equity benchmarks are heavily overweight the US. For example, today the US represents 73% of the market cap weighted MSCI world. 20 years ago, that number was around 50%. We love the US economy, and the US has some of the world's best businesses, but there are great businesses outside the US as well. And we believe if you want the best exposure, you have to be willing to look globally. We continue to find opportunities in places like Europe and in emerging markets such as Latin America and Asia, where risk appetite may be less elevated and valuations are reasonable. Second, we're diversified across sectors and market cap. Equity markets today are heavily concentrated in technology and AI stocks, and especially in a handful of mega-cap companies. The top 10 companies in the MSCI world make up over 28% of the index, versus less than 10% a decade ago. This is a risk for investors. Our portfolios are benchmark agnostic. Our sector weights look very different, not because of any top-down macro view, but because we continue to find value in sectors like healthcare, consumer staples, and energy that may be out of favor today, but which we believe offer compelling risk reward for patient investors. And finally, we continue to believe in the power of gold as a potential hedge. We see a number of imbalances and tail risks in the global economy and markets today. So despite the strong performance, we continue to view gold both as a potential hedge against market distress and also a long-term store of value that preserves its purchasing power over time.
I'd like to ask you a question about market fundamentals. Many folks who are concerned about the levels of valuations were looking to see if earnings trends have justified those market valuations. What's your view on this?
The honest answer is, I don't know. It's one thing to identify a trend in earnings, but the question then becomes, how do you capitalize that? One thing we've observed over time is that markets can be prone to over-extrapolating near-term trends in a linear fashion into the future, and that can get you into trouble. As long-term, bottom-up investors, the question we ask ourselves at the company level is not what will earnings growth look like 1 or 2 years out, but what is the durability of the business franchise that underpins those earnings? At First Eagle, we don't make forecasts because we believe the future is uncertain, and it's precisely for this reason that we focus on diversification and margin of safety and price.
Well, thanks very much for your time today, George. I look forward to talking to you next time.